Thank you very much. Would like to call to order the special called investment committee meeting of the Kentucky Retirement Systems here on October the 22nd. We have a fairly simple agenda. With that said, I'd like to have the opening statement from Legal Services.
Yes, sir. For the record, I want to note that this is a special called meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute, Section 61.826, and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. And Sherry, will you do a roll call for us, please?
Yes, sir. Mr. Lane,
Here.
Mr. Atkins,
Here.
Miss Bova,
Here.
and Miss Thompson.
Ms. Thompson had informed me that she will not be able to attend. She's out of the country at a time zone that doesn't work. So
Yes.
she will not be attending.
Thank you.
That said, I believe we have enough of us present to continue and make a vote. Do we have a public comment?
Actually, we do have two today. So I will read those now. The first one comes from Thomas Murray Wathen, and he states as follows. I have a repeat question about the turning 65 and being made to go on Medicare and paying $940 a month for my 15-year-old child of mine. Hazardous duty employees who retire and have a child under the age of 22 get the health insurance for free. Did the money I put into retirement system pay for the hazardous duty retirees with children? I don't see where extra money is taken out for hazardous duty retirees for this benefit. I won't have any money left for living after all reduction in retirement benefits for health care for my 15-year-old son. Who determines who gets what benefits? I never got a response from the last letter and will be watching tomorrow's meeting for a response. Thank you for your time. The second one that we received was from a Terry Brent Stringer, and he writes as follows. No comments. Thank you.
Yeah, okay. Thank you very much. Now, our agenda is very simple, as you see, and I'll set it up a little bit and then turn it over to Steve. What we're here today for is to approve a conversion, if you will, or continuation of investment and in the Kane Anderson Energy Fund that's going to convert into a Kraken, the Kraken Fund or Kraken company. And we've had great success with the Kane Anderson Energy Fund, but it is, as some of you know, a lot of these funds have a closing date or a date that they have to make a final distribution. And this fund is coming up on that, I believe, next year. Is that right, Steve?
I think it has we're in Fund 7. It has a little bit longer to go, but some of the series of funds are coming up on their final distributions.
But the what is to be voted on here and considered is that they're going to roll out in a continuation vehicle the Kraken piece of this fund. And as I said, this has been a very successful fund for us over the years we've had it. If you just look back a couple of years, it's been running about a 13% internal rate of return. Is that correct, Steve? Or Andy?
It's been a little challenged in terms of some of the original assets. It was done at the time of the energy kind of boom in 2016, but the assets, some of them that we have now, including this one, that are more production focused, are quite successful, and I think that's what's attractive about this one. I think it's the largest asset that's left. There's three main ones. This is about 40% of the fund, and yeah, like you said, the term's up next year. So this continuation vehicle has a term about 5 years, with two potential extensions. I think there's two ways we can talk about it a little bit, but there's probably
Yeah,
two
we'll get
ways this
back.
could go. But yeah,
We'll get back into
so it
that.
could-
But
Mhm.
what we have in front of us here is two options and two
Mhm.
only.
Mhm.
One is if we approve rolling our money into the continuation vehicle, we continue to hold what looks to be a very, very profitable asset. And the fact is, what's nice about this is we've watched this for a while. This is not a new manager, not something just done in blindly. And so we think it's very positive. The other aspect is that new money is coming into this Kraken investment as well. Lots of other people, some big money, thinks it's an attractive holding for them. Kane Anderson is putting their own money into it, and some of the individuals at Kane Anderson are putting their money into it. So I think it passes the skin in the game test. That's always has some importance. Now, one caveat that I will make here, the holding we have is a unitary holding split between the C and the K, and not equally split, but split. And the way Kane Anderson has come back to us is that it's either all or none. Both plans have to approve this or neither, and we'll just get our money back. Now, that said, we can go into the math here in a little deeper, but we don't get all of our money. If we terminate at this point, we will get most of our money back, but it's 85% of the net asset value. So we're going to leave, millions on the table if we don't, if we're not able to get both funds to approve this. So that said, I'll turn it over to Steve and Anthony, who can give you give you some more details. And I think I'll say at any point, any questions that you have, please let them fly.
Yeah, thank you, Pruitt. I appreciate that introduction. And Anthony and I'll provide a lot of additional details, but I think you did a really good job at a high level. And we appreciate everyone's time this morning, especially on short notice. And I also wanted to thank Sherry. She's done an excellent job of coordinating a number of meetings in a very short window in order to allow us to present this investment opportunity. And I know she's done a lot of hard work, and she's cursed my name a few times, but that's okay. We really appreciate her work. And we understand, and I think Anthony's the email that went out over the weekend, we appreciate that the timing on some of these deals is not necessarily ideal, whether it's, co-investment opportunities, continuation vehicles like these. Sometimes they have a very short window, where we have to do our due diligence, evaluate the opportunity or the different options and make a decision and a recommendation to the investment committee. So we appreciate your availability to allow us to do this morning. As Pruitt mentioned, the portfolios are currently invested in what's called the Kane Anderson Energy Fund 7, which is a 2015 or 2016, Anthony, 2016 vintage private equity fund.
Yes,
so it's been around. It's been around quite a while. As Anthony mentioned, if we look at where the timing of when that was, energy funds struggled certainly initially during that investment period. That was not a great time necessarily for energy funds, but Kane has done a really good job, we feel, with navigating difficult markets and really coming back from what were pretty depressed market values or values on a lot of the assets and some of the struggles with some of the early investments. So they've done a really good job, and subsequent funds that, although we're not necessarily invested in, have performed very, very well. So we're real confident in the team and their approach and kind of the change in what they're strategically, how they manage these types of funds. And as Pruitt mentioned, the major headwind that we've seen in private equity markets has been the significant slowdown in realizations over the last several years. And that's really been exacerbated by the recent rise, the significant rise in yields. So private equity managers such as Kane have begun to pursue alternatives to traditional exits, including such things as continuation vehicles. We saw this with SVP recently. We're obviously seeing it here. And this is intended really to offer investors, especially in older vintage funds, options for liquidity. As we think about some large investors and their pacing plans and their commitments, that is partially dependent on their expectations of getting liquidity back from older funds, and they're not really realizing that, so they're kind of put in a pinch, right? They have commitments to new funds, and they also have these older funds that aren't returning capital as they expected, so it's putting them in a difficult spot. So understandably, managers are being pressured to pursue different alternatives to provide liquidity to those funds. As we've talked about, we're fortunate in that we're not really liquidity constrained. We're not in need of significant liquidity from these investments, so it allows us a little extra flexibility. That's partially because we've been underinvested in private equity. We really didn't see a compelling risk return over the years, so we have capacity both to add as well as to be that provider of capital going forward, which puts us in a pretty favorable position. Kayne has offered investors in several of their existing private equity funds the options, as Pruitt mentioned, of selling 100% of their indirect interest in Kraken Resources LLC, which is an investment held across multiple Kayne funds, or option 2 is retaining 100% of their indirect interest in Kraken Resources LLC through an investment in the KEPE Continuation Fund. When we evaluate these types of options that we're presented with, we obviously consider the quality of the manager. We've done the initial due diligence with the initial commitment and investment. We do ongoing due diligence on that manager. And as I mentioned, Kayne has done a really good job of navigating what was a very difficult market. They made some changes to their strategies going forward and how they manage, which we think has been really beneficial to investors. An important aspect of our evaluation is the quality of the asset or assets being rolled into the continuation vehicle. In this case, it's the Kraken Resources, which we think is a very high quality asset, with a number of characteristics that we find very compelling. It's also very important to consider the economics of the transaction. We can't look at it we have to evaluate both from a buyer's perspective as to the continuation vehicle, as well as the alternative is we're a seller. And importantly, what's the pricing of that liquidity option? We've been through this in the ancient history for KPPA or KRS. If you go essentially to a secondary market and you're looking to sell a private investment or an alternative investment in kind of the secondary market, and not wait for the realization, what type of haircut is what we typically talk about? So what's the pricing discount that you're giving up something in order to attain that liquidity? And that's the case in most of these continuation vehicles. There's some type of haircut or discount associated with that. So from a seller's perspective, what are the economics relative to the economics from the buyer's perspective? We also obviously consider the liquidity needs of each of the portfolios and the potential risk-adjusted returns of this proposed investment. We consider it a new investment relative to the alternative investments that are available for the portfolio. So we look at this investment compared to what we're currently looking at, or what the other investment options are for the portfolio currently, and how does it stack up? Importantly, this investment would be part of the fund's real return allocation. So if we were to do the continuation vehicle, it would be moved from private equity into real return, which we know is an asset allocation that we've been ramping up. And why that would be the case is, it meets the criteria for real return. Again, this is, when we think of private equity, we tend to think of a number of different characteristics. And this investment, this continuation vehicle, would be more aligned with what we view as real return. It has compelling economics, favorable standalone risk-adjusted returns. It has low return correlations to the current real return investments, as well as to our overall broader portfolio. Provides inflation sensitivity and diversification during periods of inflation. It also provides yield and high levels of current income, which we think are important for real return investments. So we following our due diligence, our discussions with Wilshire, our recommendation, as Anthony will get into, is to roll our investment, all of our exposure, into the continuation vehicle. With that, I'll turn it over to Anthony to cover in more detail.
Sure. Yeah, thanks, Steve. This is an asset that's focused mainly on production at this point. So that the Kayne had kind of two differing strategies. The one that we originally invested in was kind of the older the thing that was more in vogue in terms of just exploration and production for the shale boom that started in kind of mid 2010s. Around that mid 2010s, I think the team that's there now did their own strategy called the Kane Private Energy Income Fund, which was focused more on existing producing assets rather than finding the newer ones. And it was less venture like, let's say. It was more these are here, we can produce these, and find accretive acreage around there as well. And that's kind of what they've done. So the buyers for this, there's institutional fund that's buying, that was the best bid. And then also the Kane Private Energy Income Fund 3, which is in the market, is also one of the buyers, and along with the Kane principals individually themselves, as Pruitt mentioned. It's in this case, this asset's the same management team. They've had a real transformation from 2020 to 24, both organic growth and also by making several acquisitions. You can, some are listed on, sorry, I don't have the page with me, but maybe page 3, I think. Here, it's the one with the timeline on it. So they made a few large acquisitions as well in the Williston area, which is in the North Dakota Montana border. So that's the acreage that they are. They also still see several opportunities around there. I think there's probably two paths for this. One, they could sell. There's definitely been, actually, in terms of private equity, this is actually one of the more active sectors in the past couple of years, because some of the valuations are so low. Things have transacted unlike other areas of private equity. And so I think this could be sold to another group, or potentially they could be a buyer and continue to grow this. So I think that just will depend on Kane's decisions and the management team and what they see as out there. But they do have a lot of opportunities they find pretty accretive. This is also producing a lot of cash flow because it's a pretty scaled asset at this point. They also have some vertical integration with disposal of water, which can cost in the 9 figures a year, but they do that internally, which is also beneficial for them. I think a criticism a lot of these times when people look at some of these funds is that they're just worried that there's a levered oil bet. We would say in this case, this strategy tries to counter that by they hedge the production, so they have good visibility. And again, that's why we think this is a good candidate to create real return. It definitely has ties to inflation. They hedge things to out through most of the production. I think 80% is their target, out 3 or 4 years. So you have good visibility in what you're having. Obviously, these assets decline quite quickly. So I think what they tend to do is, it kind of reminds me of a bond ladder. It's not exactly that, but you have wells in different stages of production and decline. So kind of over time, the newer ones come online and some of the older ones are going to be declining quickly. And so you have kind of a steady amount of production going forward. Right now, they're in the 80 to 90,000 barrel oil equivalent a day production. So if you have positive margins and have control of your expenses and a decent oil price that you've hedged out, then you have a margin that you can kind of see, and that results in significant cash flow. And that's why if you look at the next page, I think page 4, Sherry, you can see that's just our position. So if you look in the last couple of quarters, the realized column goes up quite quickly, and that's just cash coming back. Obviously they can choose to reinvest some of that, and that's what some of those acquisitions have been. They can also return some to shareholders, which has been us. And so that's some of the reasons why we think this is compelling. In addition to, also essentially when you're rolling, you're buying in at the 15% discount to the NAV, and you're not taking the fees that sellers have to. So that's another reason that we think it is compelling. So we're happy to take any questions about this if you have any, but
yeah, I think that's an important point to emphasize is the selling. So if we pick option, the cash out option, as Pruitt and Anthony both mentioned, it's not, you don't get 100% of the net asset value as of a point in time. What you get is you get a discount from that. So they discount that NAV, and that discount essentially accrues to the buyers ultimately. And then the selling option is also responsible for paying the fees of the transaction as well, which results in additional discount to what the marked NAV was at the point in time. So there is a price, as we mentioned, to selecting the cash option, which some investors are obviously willing. There's a number of investors Again, given the vintage of this, that's, are limiting or prohibiting, oil and gas investing. So they may not be eligible to invest in the continuation vehicle. As we mentioned, some are more in need of liquidity to fund commitments they have elsewhere. So they're looking to raise liquidity when they can, and they view the option of the discounted price they would receive is reasonable given their need for liquidity. Again, in our position, given the asset, we don't have a need for liquidity. Given what we view is reasonable modeling, Wilshire took a look as well, and obviously there's, as Anthony mentioned, there is some sensitivity to oil, and the modeling will account for that. We've seen the volatility in oil prices, and but it's a little bit less based on, as Anthony mentioned, a levered oil play, given their hedging strategy that they utilize. So I think it's a compelling investment opportunity, and it fits in our real return asset allocation. In fact, this is one we would have, on a standalone basis, we would certainly have considered upsizing our exposure. We think it's that compelling of an investment. Obviously, it's I guess an oversubscribed investment already. As Anthony mentioned, there's a number of large investors that are anchor investors for the new continuation vehicle. And Kane's principals, the GP is rolling a lot of their exposure, both their existing and their carried, and then on top of that, adding additional equity to the deal themselves. So personally writing checks for the deal as well. So there's not capacity for us to upsize our investment, but we think it certainly is meaningful enough to maintain our exposure.
Right. Oh, and I forgot to add also another thing that is compelling more for not selling is you don't get the proceeds up front either. There's about let's see, I think after some interim distributions and fees, there's about 70% of NAV left, and so 2/3 of that will be paid out next month at the close. But the other third is deferred payments, and secondary people like to do that a lot because it helps with IRR and things like that. But and based on Kane's base case model, the selling LPs do not get all of their money back until late 2026. So you don't get all the way cashed out even for the people who like to sell. So
Well, thank you all. I think covered a lot of the, as I say, the weeds, and very important. I think our team did a great analysis of this and dug into it. Wilshire has opined on this and approved the general structure of what's the Kraken is going forward, I believe. And if there are any questions for Wilshire, I believe they're on the line.
I have a couple questions. I don't know who they're directed towards. So in 2015, we put in 100 million. And what's the value of that investment today, or what's the annualized return? Just either.
Sure. It's the annual return. It's about a 1x, so it's basically just been flat. So it has some challenged assets, like we were saying. So the remaining there's 3 remaining that comprise most of the value, and there's a change in management as a result. So the people who are managing this now were managing the Energy Income Fund, and the assets that are left here, the large ones, are more focused on that. So it's focused on, again, the production, increasing that, and not as much of the exploration.
So this is definitely an expectation of future investment gains. We're not basing this on past performance by any means. If that were the case, we would not.
There's been past performance on this asset, right? I mean, this currently is marked, I think it's at 2.9 gross, but so this has assets done well, especially under the new team. So if you look on the page 3 under the timeline thing, they've blacked out some of these because I think they did a high yield bond issuance earlier this year, and there's some sensitivity around future numbers, but they've grown it significantly, and that's this current team, not the team that was previously did this. So yeah.
Yeah, but
Okay,
I think correctly to your point, it's not, if we look at the total fund, the total investment that was done back in 2016, in the struggle in the difficulty with the initial assets, it's certainly not based on projecting future performance based on that past performance. Although, as Anthony points out, this specific asset within the strategy and the fund has performed very well, and the expectation going forward is it will continue to perform.
Okay, and who's to say that we're not, I don't remember exactly when this new CV will be up or for re-liquidation or whatever we're doing now. Would it be fair to say that again, at that time, we'll only receive 80% of the net asset value of the assets? I mean, are we going to be in this forever?
No, the term for this new vehicle is 5 years. But like I was saying, I think that this could be sold in a couple of years. That's probably one of the two paths: is selling a full exit to another larger company. We have another portfolio company of non-operated interests through a private equity firm that was dabbling in energy, but they got lucky and it's done all. But that ended up being sold to Northern, so another company that kind of operates in that area. I could see that happening to this, or they could be an acquirer and continue to buy some of the things that are listed on page 2, the color map on there. So they're the yellow guys, and there's a lot of different other folks, some of which have varying levels of interest of staying in the game in those areas. Sorry, Share, if you go up one more page. That one, yes, this one. So Kraken is the yellow dots. There's various other folks that have assets up there and that may or may not be as interested in continuing or developing those out. So depending on how things go, that is also a possibility for this asset. As you can, I think we discussed the timeline on the next page has some of the 3 acquisitions they've done in the past 4 years as well. So yeah, I don't see this being done forever, but even in the years as it keeps going, there will be significant cash flow coming back.
And our expectation, I think to Anthony's point, our expectation for this vehicle is that it would not be one that would be likely to extend, certainly not extend to the extent that we're seeing in some other assets. And what's a little unique is when we see the continuation vehicles that are limited assets. So portfolio, if we look at a private equity fund, right, that has multiple portfolio companies in it, and what we've seen, especially in some of the older vintages, is you saw some early realizations, and what you have is a lot of tails, which in this case, the Kraken is maybe the only investment in some of the older Kane funds, right? So it's the last remaining asset. And sometimes you have assets that are remaining, and we have in some of our private equity, some assets that are either difficult to sell, or the GP or the fund doesn't necessarily want to sell in a depressed market because they see the future value of that asset, being able to unlock additional economic value in an asset. The asset's too good, right? You don't want to sell it right now in a depressed market, and you want to hold on to it. One reason to put it in a continuation vehicle. It's also unlikely to kind of tail like some of these other funds, in that this is not going to end up being, necessarily a multiple portfolio company fund. So it's not going to sell pieces of it off necessarily. It would either be probably a single transaction, and Anthony mentioned it's going to be cash flowing significantly over that time period.
Right.
So what would the dollar amount of the new investment be? So we already have 100 million in, so we'd re-up at how much?
So the total for Kraken exposure in Fund 4 is about 20 to 25 million, as Anthony showed on this performance page. So we're rolling dollar for dollar. So we're still, I believe, Kraken, Anthony has 3 assets. Or sorry, the Kane 7 has
Fund
3.
7, yeah, 3 main assets there. Yeah,
three main assets. So we would still have Fund 7 exposure. Our Fund 7 exposure would be reduced by this amount. Overall 20 to 25 million, and the new investment in the CV essentially would be dollar for dollar, so it would only be about a $20-25 million investment.
So we're going from 100 million exposure to 25 million.
So you would still have sorry, Anthony.
No,
you would still have exposure in Fund 7. You would still have, so you're essentially reducing your exposure in Fund 7 by 20 to 25 million, and increasing exposure or new exposure to this CV by 20 to 25 million. So on a net basis, your total exposure to the Kane series, whether it's Fund 7 and Kraken combined, would be exactly what it is today. The alternative is, if you take the cash option, your Fund 7 reduces and you just get cash over time, instead of units or exposure to the new continuation vehicle.
Right.
So it's no new commitment. It's no new dollars being committed.
Yep. Yeah,
But
unfortunately,
two
these are
points, two dates to keep in mind. One is, this
Mhm.
is it's not a hard well, it's a almost hard 5 years. It has two potential 1-year extensions, one at
That's great.
the discretion of the GP, and one at the discretion of the advisory committee. So, or the second year would be the advisory committee. But Fund 7 is slated to be closed in a year, 18 months or something like that.
Mhm. That's right.
We will get returns, distributions from that, but
Mhm.
that's a hard, relatively hard. I mean, never use absolutes when you're a limited partner, but
Right. Yeah,
we expect to have that back. And then this one should, as your original question, let's call it a 5-year term.
Mhm.
Okay,
But
so
yeah, I
last
mean,
question, what sort of return do we have to have from here on out to annualize a return since 2015 of 5%, let's say?
we can get back to you on that one. It's kind of a funny one because you have so much dead weight, I guess, from the beginning. So if you to get it to annualize, to increase that with with the difficult beginning is hard, but we can do the math for you if you want. So I'll get back to you on it.
That'd be great,
But
thanks.
sure, but you can see on the third page, this has gotten what 2/3 of its cost basis back in 4 quarters. So I mean, it's throwing off a lot of cash. So that's one thing at least that mitigates the, are we stuck in this for a long time? I mean, maybe, but they're going to produce in all likelihood a lot of cash. So that is something that gives us comfort.
Okay.
Rude, I have a few questions, if
Sure,
possible.
of course.
Real quick,
Mhm.
and this question is not based on the politics, morality, or ethics, but
Sure.
purely on a return on investment thinking. But when we're talking about fossil fuel production, what is the current conventional wisdom among similarly situated state employee pension plans with regards to a risk analysis of how the market will treat this kind of an asset going forward? Is there any kind of risk that we should assume because of either shifts in energy production? It strikes me that an all of the above approach is going to be where most of us need to be for quite some time as we make transitions to greener energy. But I'm just interested in, it's a question about liquidity. Is there an opportunity cost or a risk associated with the continuation of a fossil fuel investment when the price of liquidity, particularly given volatility in energy markets, might actually be a price we should pay in order to move these assets into a more predictable category of investment that would result in greater returns? So I guess what I'm looking for is when similarly situated investment advisors to public pension funds get together, how should we as trustees think about this kind of an investment, and what risks are attendant to that? And I'm not particularly thinking about the volatility associated with unrest and war in the Middle East, and the opportunity for predictable continuing conflict with Iran and disruption of shipping lanes, which could actually benefit domestic markets for energy. But I guess I'm just looking for any insights you can provide that should color our thinking about this type of investment as we think about the liquidity option.
That is a great topic, a great question, a huge ongoing discussion in markets. I'll give a little bit of a personal and in a market view. Anthony can weigh in, and Wilshire can weigh in as well. But it's obviously been a significant topic, especially in public pensions, and we've seen the full spectrum. As we mentioned, there are a number of public plans, and we probably know who some of those are, that have prohibited investing in what we'll call traditional oil and gas. there was a big move for a period of time into, what we, and Anthony and I've had a discussion about the energy transition investing. Obviously a lot of capital flowed to that. I think there's been a significant rethink recently, especially about the time frame of that transition. The performance certainly of those investments has not necessarily been great. And the time frame for how long a energy transition is going to take to occur, and our reliance on more traditional production and energy for a longer period of time, I think is certainly more appreciated now than potentially it was, over the last several years. So our view, as staff, is really that this is an attractive space to invest, and it's going to be an attractive space given the requirements and the longer runway to energy transition. It's not that we're opposed to investing in energy transition. I think in the right opportunity presented itself, that's something we're evaluating. But we think this, the more traditional is the unloved. It's a little contrarian in that it has been an unloved space, but it offers compelling economics given current valuations, given outlooks, given time horizon to transition. If we were talking a 50-year investment, that has a different proposition than what we're looking at. Do we think in 5 years the world, the U.S. is going to be fully transitioned to alternative energies? No. I think the runway is a lot longer, and that's part of what makes this compelling. The underinvestment in the space over the last several years has created a bit of an opportunity. The ethics of it aside, or whether or not traditional energy investing is appropriate or not, I think that's certainly a decision that, much like our proxy decisions that we make in the proxy policy that we have, that can be a board decision. If we've talked about whether pecuniary interest in our investing, whether we take those and ESG factors and such into consideration. We take that into consideration as far as the opportunity and the potential risk reward performance of investment. So we take that into consideration in every investment that we make. And as I mentioned, given the current situation, given our outlook for the space, and the need for more capital in traditional investments to get us through to ultimately, if we do transition to alternative energies, that runway is pretty long. So I think that's part of what makes this compelling. I'm sure Anthony and Wilshire may weigh in as well there.
Sure. I mean, I was at a conference last week and talked to an energy manager, and his belief is like, look, we're not running out of oil, but we are running out of $65 oil. I think if you think of some of the basins we have as like a layer cake, right, we drilled out some of the easier layers to get, and as that runs out, costs are going to go up. So this does have inflation ties and can be helpful for us to mitigate exposure that way. And so I think, yes, politically, we were discussing that too. I think obviously if there's regulation on production in some way that hindered that would be bad in the short term, but long term that just again increases the price of the assets in terms of, makes them more valuable because they're dear, because it's harder to get them, that increase the costs. So it could be it would be one of those negative headlines in the short term, but something that would make the assets they have more valuable in the longer term probably. So
thank you. Next question is, do we have any intel on what the orientation of the county plan is towards this, or is that almost contemporaneous with this discussion?
I'll take that one. They have an investment committee meeting this afternoon where we will be making a similar presentation. Anthony mentioned that given, again, this investment was done prior to the split, prior to two boards, two investment committees. It was a single decision investment. That's not the circumstances here. I would say that this committee, and this board would need to make they need to make an independent decision that this is what we want to do. And we'll cross that bridge if we get to it. If they're not in alignment with the decision of the other investment committee. And we'll come back to you with what that necessarily means. But from my perspective, you have what's in front of you here. It's a decision of one of two options. And I think we have to do what's best for the systems and the participants in SPRS and KERS.
Almost like it argues for like a joint investment committee. Go figure.
Yeah.
Okay. I think
David,
that
could I add one thing that is a little bit related and talking about the future? You're familiar with Alliance Resources, Mr. Kraft out of Lexington, who's done pretty well, but coal is definitely phasing down, not out, but down. His company, Alliance Resources, is taking the free cash flow from the company. First of all, they pay a big dividend, a nice dividend, but they taking the free cash flow and investing in oil and gas leases. So they believe that that's the, what time period, that's they're really smart people in their Tulsa office there, so they know that. But clearly, there are lots of people who are interested in oil and gas leases.
yeah, I just got back from the EU and visited with the ambassador, U.S. ambassador to Greece, and a few other folks. And the disruption, the price increases in the EU that are attendant with the disruption in supply from Russia, and Russia's interest in leveraging their particularly natural gas resources for geopolitical purposes has really boosted both shipping and transfer of liquefied natural gas to the EU from domestic sources in the U.S. So I think given the orientation of China and Russia and their interest in energy markets, for the EU to remain, frankly, not under the thumb of Russia, an energy strategy that reduces costs and increases availability will include exporting U.S. domestically produced energy resources for the foreseeable future. So I do think that there are forces at play that would tend to indicate in the short term, the next 5 to 6, 7 years, this kind of a play makes a lot of sense.
Well, that's good information to hear, because that geopolitical is a price booster, not a price cutter for sure. Well, if there are any other questions, we'll be open for those. If not, I think we're probably ready for a motion. And remember, the motion is however you want to make it, but we have two options. Let me call it option number one, which is to roll our investment into the Kraken continuation vehicle, and the second option is to tell them to send us our money back. I think that's a technical term, isn't it? Legal terms. Send us our money back.
Yeah, I think that's legal.
Check
Yeah.
is it. Well, I would move that the committee endorse the recommendation of staff and recommend that favorably to the full board.
And I'll second that motion. So I guess we're ready for let's do a roll call vote, I believe, on this. Would that be advised from legal?
That would be fine. Yes, sir.
All right. So Sherry, will you do a roll call vote?
Yes, sir. Mr. Lane,
Yes.
Mr. Atkins,
Yes.
Ms. Bova,
Yes, but I would like to see the follow-up information that Anthony and I discussed.
thank you.
So we have 3 in favor, and that the motion then carries. And we appreciate everyone's time, and we will definitely get some numbers to to take the current projections of the Kraken and the most recent experience and layer it back into what our original investment was and get you a number, get all of us a number, but yours, that was a good question.
Well, thank you very much. We really appreciate everyone's time, especially in the short window. So thank you very much.
Yes, thank
And
you
I
very
Feel better,
much.
feel better, Steve.
Oh, thank you.
Can I just ask a quick logistical question? What is the next meeting?
It needs to ratify this decision, and so in order for the investment to be able to be rolled over, and there is a 5 o'clock Thursday deadline to make the announcement to the to Kane. This decision of the investment committee needs to be ratified by the full board. And in order to meet the 24-hour special meeting announcements, we had to schedule it, and we didn't know how long this meeting was going to take, and so Sherry scheduled the full board for 10:30. It should be a very, very short meeting. If you and Mr. Adkins and Mr. Lane appear, since there won't need to be as much of a full discussion.
So I just want to, I won't be available. So is that fine? I don't need to attend.
I don't know how many others will be available. We need a quorum of the board, so we need 5 members of the KRS board to be present. So I cannot say yes or no because I've not heard from the rest. I did hear from Ms. Hampton this morning, so I know Ms. Hampton will be present for sure.
I have only heard back from Mr. Summers that he will not be able to attend. So I only know of one that will not be able to attend today.
Yeah, we won't need to get into the all the detail in that meeting, and I'll let Ms. Hampton sort of steer us there. But I think the full board has great confidence in the investment committee. I hope. But thank you all very much, and now we can go get a fresh cup of coffee and get ready for the next one. And thank you for attending this one, Ms. Bowe. That was very, very helpful.
Thank you very much.
Thank you.
Thank you, Mr. Chair.